I focus a lot on emerging markets. And the opportunity set today is pretty rich. There's like 100 countries that you can invest in the EM space. And when you invest in these countries, there's a lot of factors at play, but political risk and analysis is an important piece of that. There's always some countries that are doing the right thing, that are a bit overlooked. Assets are underpriced. Those are the gems within the asset class.
Welcome to the Tao of Chao podcast, where we will try to find balance and provide a clearer path forward in this uncertain world.
Today, my guest is Michael Cirami, Managing Director of Artisan Partners and Lead Portfolio Manager of the firm's Emerging Markets Debt Strategies. Previously, Michael was the co-director of Emerging Markets and Portfolio Manager on Eaton Vance's Emerging Markets team. Before that, Michael worked at State Street Bank in Boston, Luxembourg, and Munich, and with BT&T Asset Management in Zurich. Michael earned his Bachelor of Science degree cum laude from Mary Washington College and an MBA with honors from the William E. Simon School at the University of Rochester. He also studied at WHU Otto Bischheim School of Management in Germany. And here is our guest. Hello, Michael. Thanks for being my guest today.
Thanks for having me. Yeah.
Over the years, I have watched you really smartly navigate it through the treacherous, shall we say, emerging market bond landscape and really searching for investment opportunities. I know you went traveling, and we're going to talk a little bit about, your recent travels and so on, not just for fun. Hopefully you had a little bit of fun, but really for your work. I looked up a little bit of numbers, and I found it kind of interesting. So currently, out of 187 countries, the average 25 advanced economies is reporting about 4.3% of inflation. And the 162 emerging and developing economies is reporting 14.7% inflation. That seems like a pretty big, about 10% difference. But this average does not really tell us about the range. And if you look at Afghanistan, it's minus 6.5% to a whopping 398% in Venezuela. I can understand why, just because those two countries. And out of the 35 central banks, 6 of them have cut rates, 13 of them have hiked rates, and 16 of them just held rates during the most recent meetings. I mean, to me, this shows a real mix of economic picture and expectation and what's going on. And you deal with the whole world here. Literally the whole world here. I'm trying to understand, how you think about today's global economy as we continue to recover from the COVID-19 disruption. Tell us a little bit about your thoughts as you see the world.
Sure, absolutely, and thank you, Phil, for having me today. I know this is going to be a fun conversation as always with you. So you threw out even some data that I wasn't familiar with. I have to be honest, I wasn't on top of Afghanistan's inflation print, but to a large extent, I guess it helps describe the rich universe that's out there. I focus a lot on emerging markets, but the big economies. The U.S., the Eurozone, Japan, China, which I guess is an emerging market, set the tone to some extent, really drive the global economy. And, when we think about looking at countries, you always want to have, that kind of tucked into your mosaic. And so when I look at the global economy today, the thing that really kind of flashes in bright lights to me is the word uncertainty. So there's just like a lot of question marks out there in the world: global growth, inflation, the central bank policy and the Fed and the ECB, the BOJ. You have geopolitical conflicts that are flaring up to an extent that really hasn't been the norm, let's say, in the last, 15 years or so. You have war in Ukraine, unfortunately, as well, which adds to the mix of the great unknowns. And then there are the things out there that are going to pop up that might not even be on our radar right now. So I think of like the global backdrop is just one that's more uncertain today than in previous periods, and that's helping frame our thinking about our thinking when we're investing in, specific countries around the world.
So when we hear, well, most people hear these uncertainties, we tend to think of danger zone or blinking yellow lights. But uncertainty can also mean opportunities, right? Thank goodness for uncertainty. If everything is certain, I guess there is no opportunities left.
Yeah.
And we look to professionals like you and your team to really, tease out what are uncertainty that we really don't want to touch and what are uncertainty that maybe there are some things there. So I think investing in emerging and developing country bonds has always been sort of involved a couple of extra things called political and currency risk. And for our conversation, I'm going to use just call these, developing and emerging as just emerging bond.
Sure.
But of course, emerging and developing countries are not a single and monolithic market, right? There are so many countries. There's a lot more countries in that basket than in the advanced economy or developed markets. I guess it's not unlike other, investment assets, stocks and bonds and other things. Long-term return commensurate with risks. So you talked about uncertainties, and you talked about, geopolitics and all those type of things. How do you think about EM bond opportunity today? Are there more opportunities or are there less opportunities, or how do you think about that right now?
Yeah. So, the opportunity set today is pretty rich. It's almost an evergreen statement. I could be pretty biased or accused of being biased. And when I say it's pretty rich, I don't mean that it's like cheap. Actually, I think at this point in time, there's been, a decent bid for a lot of emerging market assets. But the opportunity set is rich because there's a lot of things that are overvalued. There's things that are fairly valued, and there's things that are undervalued. And EM, can be, the universe can be sliced and diced in different ways. And I think when you are, practicing investing in this space at its best, it's a very broad universe that usually has a number of things on offer. When you approach this asset class in the worst way, it sounds like the BRICS. 5 countries doesn't really represent this broad universe. It doesn't capture places like Afghanistan or Venezuela. I would say both are truly not on the investment map at the moment. But there's like 100 countries that you can invest in the EM space. And when you invest in these countries, as you pointed out, it's, there's a lot of factors at play, but political risk and analysis is an important piece of that. And so when you have that broad universe, there's always some countries that are doing the right thing that are a bit overlooked. Assets are underpriced. And those are the like gems within the asset class. And then there's always things that are maybe captured the attention of investors to too large of an extent. Asset prices have moved too far too quickly. And the name of the game, I guess, is kind of avoiding those overvalued places and going to spots where just the risk premium is mispriced a bit. Or in some cases, mispriced a lot, actually. So
that's great. We're going to get a little bit into how you think about what is considered rich and not so rich. And I guess those are all relative statements. But for the longest time, and I guess it's still true, that they used to always say that if U.S. coughs or sneezes and the rest of the world catch a cold, that remains to be, I think, true.
Yeah.
How do you look at your EM opportunity set? Do you think about the developed market, the coughing and the sneezing, or are they coughing and sneezing? And how do you think about that when it comes to then you start thinking about what EM countries may be going to catch a cold or may not? And can you just sort of share a little bit how you're thinking on that?
Yeah, this idea that the U.S. Sneezes and the rest of the world catches a cold. I buy into it to a small degree.
Okay.
I don't want to say that there's no truth to that, and we could find plenty of episodes where where it plays out that way. But EM's a broad universe, right? You have China, part of the EM
Yeah.
universe. You have Russia, which was, I guess, once part of the EM universe. It's been largely canceled as an investment destination. You have Brazil, you have Mexico, you have Turkey, but you also have places like Zambia, Kenya, Mauritius, Armenia,
Hmm.
Uzbekistan would be another example. And so that's like a very broad continuum. And there is ample space in many of these countries to perform well based on their own domestic situation, the policies that they have put in place. And I'll try to maybe I'll try to use an analogy that might sound familiar to people. I mean, think of like U.S. equities, right? If the economy is going into recession, that's pretty bad for nearly every company. But let's just say you're dealing with a very small company in an industry that maybe has a fraction of a percent market share, but they might have some really innovative aspects to their product or their offering. They should still be able to grow despite the pie shrinking and the economy in a bit of recession. And I think we've seen examples like that over and over again in EM. And I'm not just talking about how the economy performs, but I'm also talking about how asset prices have performed in some of these countries. Because they're truly coming from a different base of development, and if you put in good policies, it makes a big difference for how assets should be priced. And so that's where I think I don't believe in this setup where we need to be focused on the U.S. so much and make sure it's not coughing and sneezing.
Interesting. So one of the things that I think about more recently in the last couple of years, as inflation start coming back post-COVID, well, all the post-COVID, the beginning of the recovery, shall we say?
Sure.
It was well broadcast that U.S. Inflation is up, was going up pretty quickly, and it was no surprise that the Federal Reserve is going to increase its rates. Now, nobody anticipated at that speed, but people expect it to go up. And in anticipation of that, is my understanding, many emerging market central banks have sort of preempted it by raising their rates first. Because one of the things that we're going to talk about, I guess, is currency, right? That plays an important role if it's denominated in local currency, their own currency. So apparently a lot of central banks have raised their rates to a fairly healthy number in anticipation or ahead of, however we want to say it, of what the developed markets like US and ECBs of the world, or UK, are raising rates. But I assume not every country did it, but many countries have. And because they did that, I think that this time is a little bit different than in the past, and actually set up some opportunities that as inflation start coming down, that we can benefit from it. Can you share a little bit about your experience in that area and what's your thought on all that?
Yeah, so inflation played out differently throughout the world, actually. Most of the world, saw this inflationary kind of impulse like we've experienced here in the U.S., but Asia was a bit different. Certainly, there was some inflation in certain countries, but by and large, is pretty tame and pretty mild compared to what we saw in the U.S. Europe was particularly bad. Actually, they suffered from the gas issues that they had last year. Around the war with Ukraine and just the interruption of supplies. So you had some general dynamics that played out differently, and then some layered in some regional differences. And central banks responded differently throughout the world. So in LATAM, I think they did what you described. They went early.
Yeah.
Maybe I'm not sure if this is a generous description or not, but many believe that they're just more experienced with seeing inflation in Latin America, so they can spot it quicker and they could react quicker to that. And that would certainly, I think, fit the fact pattern. And we're seeing inflation come down now. We're seeing central banks in Latin America cut rates,
Yeah.
and so they're have a different sort of rate hiking cycle than in the U.S. and elsewhere. Europe was a bit late, so not just the ECB, in my opinion, but throughout Central Europe, and they were not particularly aggressive. Inflation got quite high in a number of these countries. We're talking high teens and 20%. In countries that have typically seen low inflation over the past 15 years, we're at the point where central banks in that part of the world, and really to put like a specific location, I'm talking about places like Hungary, Poland, Czech Republic, Romania, and I'm speaking in general terms about them. But they're at the point where they're just starting to cut or trying to remain on hold. I personally think the inflation is running still a bit too hot there, and I'm not sure that the central banks will be able to chart the course that they desire to. But Asia's been completely different. I mean, policy rates in many countries have not moved in a material way, and quite frankly, to their credit, maybe they got it right that they didn't need to tighten policy so much, and inflation's coming back down. And I guess like I'm passionate about EM, and I think this is like one of the examples of that where you get very different dynamics at play, which is just great for an investor because you could then kind of pick and choose and move around, to where the best opportunities are.
So let's turn to a little bit about currency and EM bonds, because obviously,
Yep.
maybe not obvious to everybody, but to me, it's obvious that if we buy in somebody else's currency, the exchange rate will affect how my return is going to be, either positively or negatively. So EM bonds, like this well, it comes in a few varieties. It's the hard currency, which is the U.S. We call it hard currency, U.S. denominated bonds, or local currency, which is in their own currency denominated bonds, and then there's the sovereign bonds by the sovereign, and then there's corporate issuers.
Exactly.
So how do you go about, from a sort of a top-down standpoint, sort of first cut standpoint, look at these basic types and say, now is the time, because I'm just making it up as I go here. U.S. dollars has been very strong, and that informed me to be probably more thinking more about dollar denominated, or can you talk a little bit about how your thinking process in tackling just something basic like U.S. denominated or hard currency vis-a-vis local, and then of course many of the local are in sovereign, right? And then there are some corporate issuers. Can you talk a little bit about that?
Yeah. No, I think what you're describing is certainly the lay of the land for emerging market debt, which is one of the interesting pieces, but the challenging. It's not one thing. And those assets, the dollar-denominated assets, the local assets, they are vastly different in terms of the return prospects, the risk profile, and how they ultimately perform. So in any given year, one part can be doing well while another part can be doing poorly. So let me actually say that slightly differently to make sure it's understood. Brazilian debt denominated in dollars could do poorly, while Brazilian debt denominated in its local currency can do very well, which is kind of weird.
Yes.
And so many approach the asset class as you're describing, top down. Let's have a view of the Fed, the dollar. Yes. Let's make a decision whether we want to be in local, whether we want to be in hard currency. That is a very common approach. That is not what I do.
Okay.
That is an approach that, I think is very difficult. I'm sure there are some people out there that have success in approaching it that way. But those people are more talented than I am, perhaps, because that's why I'm not.
That's why I'm not in your business. I already made a mistake.
No. We talk about this a lot in the office here. This top-down approach, and the reason why I think it's difficult is because that decision is a hard one because that market's efficient, right? Yeah. It traces its roots to Fed policy, dollar strength, dollar weakness. Those are like there's lots of eyeballs on that. I mean, I don't know how many Fed watchers there are in the world, but it's got to be 10,000 plus. And so that's an efficient market. The Fed's, what the Fed's going to do, tomorrow. And sometimes that market will get it wrong, but most of the time it will get it right. And it's really hard to do top down. We've always approached it bottom up. So we try to spend a lot of time in the weeds on a particular place, Serbia as an example, or Poland or Uzbekistan or whatever it is that's attracting our attention. And we try to understand what's going on and how those local policies will impact the various assets. And if we think one is mispriced, then we want to own it. And hopefully at the end of that process, you have a mix of assets and you're largely indifferent to what the Fed's going to do.
Yes.
And that's, that I think is the best way to approach emerging market debt as an asset class. The top-down approach is really tough. And I'll bookend it with another way to describe this. Like, you can approach the asset class by just focusing on the Fed, the ECB, energy prices, and what China's doing, and ignore everything that's happening in emerging market countries, and just get those calls right and tinker with, local assets, external assets, dial up the risk, dial it down based on studying those things. And that's a legitimate approach. Or you could de-emphasize that, maybe have some minor views that you tuck into your mosaic, but just focus on the countries themselves, macroeconomic and political analysis, and make investment decisions there. And that's the bookend, I think, of how one can approach the asset class. And then there's a blend of that, obviously. We're more on this end of countries.
So just one more follow-up. As a U.S. investor like me, and if I'm looking at EM debt, I live with U.S. dollars, right? So to me, that's critical. Yep. So like to your point, Brazil can be very positive and lots of opportunities that in real it would have done very, very well. But by the time when you convert it back to US, not so much.
Right.
So do you think about doing fundamental analysis on a country by country, situation by situation? It sounds like that's what you are doing. And you identify these opportunity sets. And then do you still need to come back all the way up and say, okay, how does that cross-reference back to US? Am I correct or no?
Yeah, the way I'm hearing it, and I agree 100% if I'm hearing it the way that I think you're saying it, you need to value those assets at the end of the day in US dollars.
Right.
So it's not one thing to say, oh, I bought this asset in Brazil and it went up 100%, but the currency went to zero. Like, other than a nice vacation in Brazil, perhaps, like that's not gonna help anyone. So when we're looking at any asset anywhere in the world, we bring that valuation back to dollars. And what I'm suggesting is that a currency in some other part of the world that is being backed by good policies will hold up in dollar terms. That's what I'm suggesting. And we've seen that actually this past year. We've seen it past 18 months. The dollar strengthened a lot, but that was mostly against developed market currencies, the euro and others, who were probably running looser monetary policy than the US. But EM, there are many currencies that have appreciated versus the dollar during what is generally described as a strong dollar period. And I'm not suggesting that this happens all the time. I'm a little bit surprised on some of the currencies that have appreciated versus the dollar. But there's I'm trying more to make the strong case that there's ample opportunity for a country to do the right thing and have its economy and assets perform.
So we think about portfolio construction for a second. How to use why should we even bother with the EM bond exposure?
Yeah.
People always say that diversification is only free lunch in investing.
Yeah.
Where there are some zigs and we want some zags, and some zags and we want some zigs, so that the portfolio doesn't go up and down in concert, and that it balances out. And over time, in theory, and also in practice, that the portfolio would get to the destination a little smoother, cutting off the highs of and the bottom as well. How does EM bond accomplish that? If you can share a little bit about in terms of diversifying, it's not just diversifying a bond or fixed income portion. I think it diversified across a whole portfolio. It's how I think about it. Could you sort of share with us a little bit about what your thoughts on that?
Yeah, I mean, I think that's exactly right. When I think about the investment case for the asset class, diversification kind of sits high up on that list. I also think the markets in general are more inefficient in the emerging market space. So there's like alpha opportunity, but diversification, I think, is a really important piece. When I think of any asset, like I think you need to think about the underlying risk factors that drive the price of that particular asset. And so for emerging market countries, it's those policies that are in the individual countries is the case that I'm trying to make here. So, when you think about, let's say, a place like Serbia, you could think about fiscal policy, monetary policy, income policies in that country, trade policies. All of those things are like critically important, and they're specific to Serbia. So unless your existing portfolio already had a lot of Serbian assets, like this is something that's going to be new and different in the portfolio. So I think it helps diversify the portfolio, directly to the core. I'll further add that I think all assets in the EM space, and this is probably true for any asset actually. I think about it like there's these two pieces. You have general market beta, and you have idiosyncratic risk. And those are the two pieces that really, stick out. And for EM, depending on the country, that general market beta risk can be quite small. And that idiosyncratic piece can be quite large. Mm-hmm. Now, when we're talking about a country like Brazil, that market beta is larger than what you would see in a place like Serbia, which would have that general market beta smaller. And if you go to a place like maybe Uzbekistan right now, that general market beta is extremely limited. And so that's how I think about the diversification piece. This is why it's so important to have this broad universe. If you invest in the BRICS, like you have, I don't know, I'm making this up, 70, 80% general market beta of EM. Mm-hmm. But when you put together a portfolio with 30, 40, investments around the world, that sounds more like Serbia and Uzbekistan and Uruguay or something like that, you get this idiosyncratic, risk pattern. And that's what's really appealing. And that's what traces into the diversification benefits.
Michael, when I first knew you, I don't want to date myself, but over a decade ago, you come to Washington, you attend World Bank, IMF meetings, and you meet with, bankers. I always find that really fascinating that they are so willing and able and to spend time with professionals like you who may be interested in their sovereign debt, let's just say.
Yeah.
Or to learn about their policies or what have you. Cite as an example, I know recently you were in the Balkans. I think you already mentioned Serbia a couple of times.
Yeah.
What are some of the things that you and your team do in country? Is it really meeting with these bankers and meeting with, if it is corporate, you meet with corporations very much like an equity investor would? Talk a little bit about, give us an example of how you go about doing this.
Sure, yeah. So I'll target my comments on this for sovereign assets, because like when you're looking at corporates, it's different. And I'm happy to talk about that too. But for when you're thinking about sovereign debt, there's usually like a standard set of meetings you want to have. You want to talk to the Ministry of Finance. You want to talk to the central bank. Maybe there's an IMF employee in the country that you're interested in, that you'd want to talk to. The World Bank could be present. There's private sector economists. There's political scientists. There's local business people. You kind of want to like have the conversations that can deconstruct a country into its various like component parts, maybe component policy parts, understand how a country got to that specific point in time and what policies are going to look like going forward. So you want to talk to as many people as you can. And everyone always talks about talking to the taxi drivers and stuff like that. And it's like, yeah, you want to have those conversations. You're at a restaurant, strike up a conversation with the waiter. You really just want to understand what's happening in a place to help you form a view. Personally, I think there's no substitute for just getting out on the road and traveling to countries. And we do these types of meetings over and over again. And then you meet with the same people at the IMF meetings in Washington, D.C., and other regional development bank meetings and the like. Understand the country well, be able to identify inflection points is really important. And that's the work that happens when we're in country.
And so before you go to these countries, obviously you already done a lot of studies, you already know it. So you target certain countries. Like, for example, you went to the Balkans because you have already a view and you want to confirm that view or get more insight. Is that basically how that trip will help you?
You want to confirm the view or you want to reject it. You don't want to just be wedded to a particular view, but you want to go and you want to learn. Like, we're students of the world and we want to understand, how the world works. And I'm describing it as like each country, it's its own little island, but they have neighbors and there's regional dynamics. And we need to understand that as well. So, when I was in the region, I stopped in Kosovo. And had a meeting there. And that's not like an investment destination just yet, but you want to go and learn. I've been to Syria to help understand regional dynamics pre-war.
Interesting.
There was a glimmer of hope that they were going to start reforming the economy, and you show up. One of the most fruitful investment destinations that I've been involved in over the last 20 years is the Republic of Georgia. And I went to visit the country and have meetings because of an article I read in The Economist. And I was just like really impressed with like what they were doing there, particularly under the economy ministry. And I was like, I need to just go and find out like what's happening here and learn. And, it's turned out to be a place that we've invested in the past.
You make your career so exciting. Maybe one day when I grow up, I want to be an EM debt manager or on your team.
It's certainly something to work towards, Philip. But you're always welcome to come join us on our excursions around the world. So
thank you. One recent in the last probably at least the last 4 or 5. World Bank and IMF meetings have been a lot of emphasis about how China BRI lending somehow it's in conflict or it's not in the rules-based approach in working with the global South primarily.
Yeah,
I guess 2 questions. One is, what's your thought on BRI in terms of its lending and infrastructure? And is it really so dire the way that certain articles talks about it? Or is it really just one version and that we shouldn't treat BRI every country the same? There are local issues, there are construction issues, there are all kinds of issues. But at the end, there seems to be a competing debt issue. Who has preference, who has right to get money back first and all that. Can you sort of help us to understand a little bit about that and how that affects you in any way when you start looking at country lending?
Yeah, a lot of questions wrapped up into that one. So if I miss something, come back to it. But let's start with the lending. I think it's important as an investor in any asset class to have a skeptical, critical eye. Your money's leaving and going somewhere else, and you need to make sure it comes back, hopefully with some returns attached to that. And so what investors like is information and transparency. And unfortunately, when China's involvement in many countries, lacks that sort of transparency.
Mhm.
A lot of the lending is done under non-disclosure agreements. It's also done in, some of the projects are done in ways that make the watchful eye, or challenges the watchful eye, maybe is the way to state it. And so when we see heavy involvement of China in a particular country, it becomes a little bit of a red flag. And what that means is like we need a little bit more risk premium in the assets that we're going to buy there, because we have that uncertainty about the project, the cost, the repayment terms, perhaps, the quality of the execution of the project, are all kind of issues that play out. And there's numerous stories out there, and I've seen some of it firsthand. I was in the Copper Belt in Zambia. This has got to be over 10 years ago, and we're driving around visiting mines. And on one road, a dirt road, nice and smooth, the driver, turns to us and says, "This road was made by the Italians 30 years ago." And then, we get off that road, we get on another road, it's bumpy, we're going much slower. He said, "The Chinese made this one a couple years ago." Completely different outcomes there. So, that's a little bit of a dated story. I think countries are much more attuned to these types of issues, and are just, taking care to make sure that they're going to be left with quality infrastructure. But it's nevertheless, it's still something that lingers out there. And then you have issues on the back end when, if and when things go wrong, and we end up in a default situation, China's position as a creditor to these countries and where it really sits in the debt stack as a preferential lender or not. And this is like the debate that's raging right now, where a lot of these loans, China wants to make sure that, or is pushing for the position that they're, lent on par with the multilaterals like the IMF and the World Bank. And we don't really know how this is going to play out fully quite yet, and it's early days. So in my mind, I'll go back to the statement I said earlier, like it doesn't make this a complete no-go for investing in these places. It just adds to the risk premium. And I would maybe, to go to your diversification question or go back to that, this is a different risk than people probably have in their portfolio. And,
That's right.
You can get properly compensated for that risk if you're doing your work properly.
So when you talk about properly compensated, are you saying that these borrowers have to basically pay a little bit higher rates?
Yeah.
And do you or other managers have the scale to say, hey, look, if you want us to take down X number of dollars, you got to bid us a little higher? Or how does it really work?
Well, I mean, like every other asset, you have primary issuance, and then some big players might drive the valuation there, but then there's a secondary market, and these assets trade, and they get to their equilibrium price. So like China's involvement in different countries, some of it's not as well known at various points in time. Then it could better spill into the public's awareness, and can move asset prices.
So it is your and your team's job to kind of know much of these different risk levels and what is a reasonable compensation.
Yeah.
And ascertain what they are and so on. It sounds like a big, not only sounds like, it is a big job, because you have to sort of uncover a lot of risks, and then at the same time uncover opportunities. So they are the flip side of the same coin.
Exactly. And as you can imagine, it's multiple parts art and some parts science. So it's there's a big judgment element to it.
And a lot of it is information. I mean, that's why you're in country.
Yeah.
Right. You got to see with your own eyes, talk to the people, and then make your own assessment, not just reading some article like that may get you started, but certainly doesn't end there.
That's right.
And I think that's critically important to continue to travel and do all that. The other question out there today is about Japan. It has been, it started with the lost decade, and then lost 2 decades, and then deflation, and they cannot get inflation back. So they have been at zero bound or zero interest rate for the longest time, and they end up owning, I think, something ridiculous, like 70% of the equities in the country, and they own majority of the bonds in the country. And one of the big things is that they have kept the 10-year yield, 10-year of the Japanese bond at zero or close to zero, whatever it is. There's a lot of talk that because inflation has come back some higher than it's been for a long time, I think in the 4% range. Don't quote me on that. And there's been a lot of talk about the last governor of Bank of Japan leaving, hinting or giving that flexibility for his successor to be able to move in an upward way in terms of rates.
Yeah.
And why is all that important? I guess is because it's always been the currency you borrow from because it's so low and invest elsewhere. I think they call it the carry trade.
That's exactly right. Yeah.
What's your thought on, does it matter to you from an EM fixed income manager standpoint, what Japan is doing or not doing? And if it matters, how does it matter? Does it affect you in any way because of the carry trade? They're borrowing from them and maybe investing in some high yielding EM space that may become threatened if that no longer is the carry trade. I'm just thinking out loud.
No, I think it's something that makes sense to be on people's radar, and we're certainly, paying attention and have our own views. But I'll share my view, I guess. I know it's not exactly your question, but I've been waiting 20 years for policy normalization. I wouldn't, bang the table telling you it's going to happen soon, but it's starting to look a little bit odd, right? We are seeing inflation pick up. The economy seems to be doing reasonably well, and then you have interest rates in the 5s and 4s in the Eurozone and the ECB. This is really starting to stand out, as being a bit different, and the currency in Japan has been weakening. And so, your point on the carry trade and the yen as a funding currency is, I think, spot on. And I'll just describe the way that works a little bit. It's you borrow some yen and you convert it into Turkish lira. Yes. Maybe not the best example today, but interest rates in Turkey are 25%. We'll call them 0 in Japan. And if the Turkish lira doesn't depreciate more than 25%, you're doing well.
Yes.
That's the trade. It if and when the BOJ starts to normalize in some way, it's going to cause at the margin that carry trade to unwind. It's in EM. That carry trade is also in the periphery of the Eurozone. So, bonds issued by Italy and Spain and things like that. So we could see spread widening there, currency weakness in EM. All of that is, I think, a very likely consequence. When that will happen, I have no idea. I'm not going to sit here and try to just, come up with an investment program predicated around, that event. What I'm hoping to do is build, diversified portfolio within EM that will, hold up, well in that environment. And I'm as fearful of that as, fearful of the war in Ukraine spreading across the border or lingering on for another year, or energy prices, moving meaningfully in one direction or another, which, could be destabilizing for EM. And but going back to the BOJ and the yen, I would just, I'll end by saying that dynamic of that unwind of the carry trade is going to be more prominent in those larger, well-established EM countries like Brazil and Mexico and South Africa. And it will have, very little to do only through, secondary channels. It will have, will have very little to do with places like, I'll go back to Serbia and Uzbekistan and Uruguay or Dominican Republic, like those smaller second tier, third tier EM countries.
Thank you so much, Michael, for joining me on this podcast. And, we live in a complex world. I mean, this is a defined term, complex world, with so many moving parts. And based on our conversation today, there are lots of opportunities, right, in the EM bond space, either in hard currency, local currency, whatever that may be.
Absolutely.
So it is also clear that investing in EM and global bonds should be handed over to professionals, because although I may like to go to all these places, I have no idea who to talk to, what I'm doing, who have a view like you and have boots on the ground to execute those convictions. So I think it's clear that when you talk about alpha, which is basically manager adding value, this is one area, like you have said, because information is not perfect and it's not transparent, that hard work pays off. And we really shouldn't be doing it ourselves or using some kind of an index or passive approach. So thank you so much for sharing all that insight and your travel and what you and your team do. And I hope to catch up with you, hopefully not too long, and to follow up on other things that you may be doing that is exciting and interesting.
Right. Well, thank you, Philip. It was as always a pleasure talking to you. And I would say, leave it, as you said, leave it to the professionals. Go travel, enjoy the food and the culture and all of that. But right. leave the work to others.
Hope we'll get to do this again soon.
Thank you very much.
You can always find more episodes by visiting philipchao.us/podcast or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchao.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.